Corporate haven. A corporate haven, corporate tax haven, or multinational tax haven, is a jurisdiction that multinational corporations find attractive for establishing subsidiaries or incorporation of regional or main company headquarters, mostly due to favorable tax regimes, not just the headline tax rate, and/or favorable secrecy laws, such as the avoidance of regulations or disclosure of tax schemes, and/or favorable regulatory regimes, such as weak data protection or employment laws. Modern corporate tax havens, such as Ireland, the Netherlands, and Singapore, differ from traditional corporate tax havens, such as Bermuda, the Cayman Islands and Jersey, in their ability to maintain OECD compliance, while using OECD whitelisted IP-based BEPS tools and debt-based BEPS tools, which don't file public accounts, to enable the corporation to avoid taxes, not just in the corporate haven, but in all operating countries that have tax treaties with the haven. While the headline corporate tax rate in corporate havens is always above 0, e.g. Netherlands at 25%, UK at 19%, Singapore at 17%, and Ireland at 12.5%, the effective tax rate, ETR, of multinational corporations, net of the BEPS tools, is closer to 0. Estimates of lost annual taxes to corporate havens range from $100 to $250 billion. To increase respectability and access to tax treaties, some havens like Singapore and Ireland require corporates to have a substantive presence, equating to an employment tax of circa 2 to 3% of profits shielded via the haven. If these are real jobs, the tax is mitigated. In corporate tax haven lists, Cornet's Orbis Connections ranks the Netherlands, UK, Switzerland, Ireland, and Singapore as the world's key corporate tax havens, while Zuckman's Quantum of Funds ranks Ireland as the largest global corporate tax haven. In proxy tests, Ireland is the largest recipient of US tax inversions, the UK is third, the Netherlands is fifth. Ireland's double Irish BEPS tool is credited with the largest build-up of untaxed corporate offshore cash in history. Luxembourg and Hong Kong in the Caribbean Triad, BVI Cayman Bermuda, have elements of corporate tax havens, but also of traditional tax havens. Unlike traditional tax havens, modern corporate tax havens reject they have anything to do with near-zero effective tax rates, due to their need to encourage jurisdictions to enter into bilateral tax treaties which accept the haven's BEPS tools. Cornet show each corporate tax haven is strongly connected with specific traditional tax havens, via additional BEPS tool backdoors like the double Irish, the Dutch sandwich, and single malt. Corporate tax havens promote themselves as knowledge economies, and IP as a new economy asset, rather than a tax management tool, which is encoded into their statute books as their primary BEPS tool. This perceived respectability encourages corporates to use havens as regional headquarters, i.e. Google, Apple, and Facebook use Ireland in EMEA over Luxembourg, and Singapore in APAC over Hong Kong/Taiwan. None use the BVI Cayman Bermuda Triad as a regional headquarters. Smaller corporate havens meet the IMF definition of an offshore financial center, as the untaxed accounting flows from the BEPS tools artificially distorts the economic statistics of the haven. For example, Ireland's 2015 Leprechaun Economics GDP, Luxembourg's 70% GNI to GDP ratio. Most of the 10 major tax havens are in the top 15 GDP per capita proxy tax haven list. The distortion can lead to overleverage in the haven's economy, and property bubbles, making them prone to severe credit cycles. Global BEPS hubs. Modern corporate tax havens, such as Ireland, Singapore, the Netherlands and the UK, are different from traditional offshore tax havens like Bermuda, the Cayman Islands or Jersey. Corporate havens offer the ability to reroute untaxed profits from higher tax jurisdictions back to the haven, as long as these jurisdictions have bilateral tax treaties with the corporate haven. This makes modern corporate tax havens more potent than more traditional tax havens, who have more limited tax treaties, due to their acknowledged status. Tools. Tax academics identify that extracting untaxed profits from higher tax jurisdictions requires several components. Once the untaxed funds are rerouted back to the corporate tax haven, additional BEPS tools shield against paying taxes in the haven. It is important these BEPS tools are complex and obtuse so that the higher tax jurisdictions do not feel the corporate haven is a traditional tax haven, or they will suspend the bilateral tax treaties. These complex BEPS tools often have interesting labels. Execution. Building the tools requires advanced legal and accounting skills that can create the BEPS tools in a manner that is acceptable to major global jurisdictions and that can be encoded into bilateral tax treaties, and do not look like tax haven type activity. Most modern corporate tax havens therefore come from established financial centers where advanced skills are in situ for financial structuring. In addition to being able to create the tools, the haven needs the respectability to use them. Large high-tax jurisdictions like Germany do not accept IP-based BEPS tools from Bermuda but do from Ireland. Similarly, Australia accepts limited IP-based BEPS tools from Hong Kong but accepts the full range from Singapore. Tax academics identify a number of elements corporate havens employ in supporting respectability. Aspects. Denial of status. Whereas traditional tax havens often market themselves as such, modern corporate tax havens deny any association with tax haven activities. This is to ensure that other higher tax jurisdictions, from which the corporate's main income and profits often derive, will sign bilateral tax treaties with the haven, and also to avoid being blacklisted. This issue has caused debate on what constitutes a tax haven, with the OECD most focused on transparency, the key issue of traditional tax havens, but others focused on outcomes such as total effective corporate taxes paid. It is common to see the media, and elected representatives, of a modern corporate tax haven ask the question, are we a tax haven? For example, when it was shown in 2014, prompted by an October 2013 Bloomberg piece, that the effective tax rate of U.S. multinationals in Ireland was 2.2%, using the US Bureau of Economic Analysis method, it led to denials by the Irish government and the production of studies claiming Ireland's effective tax rate was 12.5%. However, when the EU fined Apple in 2016, Ireland's largest company, €13 billion in Irish back taxes, the largest tax fine in corporate history, the EU discovered that Apple's effective tax rate in Ireland was circa 0.005% for the 2004 to 2014 period. Experts in the Tax Justice Network confirmed that Ireland's effective corporate tax rate was not 12.5%, but closer to the BEA calculation. It is not just Ireland, however. The same BEA calculation showed that the ETRs of US corporates in other corporate tax havens was also very low: Luxembourg, 2.4%, the Netherlands, 3.4%. When tax haven academic Gabriel Zuckman published a multi-year investigation into corporate tax havens in June 2018, showing that Ireland is the largest global corporate tax haven, having shielded $106 billion in profits in 2015, and that Ireland's effective tax rate was 4%, including all non-Irish corporates, the Irish government countered that they could not be a tax haven as they are OECD compliant. Financial impact. It is difficult to calculate the financial effect of tax havens in general due to the obfuscation of financial data. Most estimates have wide ranges. See financial effect of tax havens. By focusing on headline versus effective corporate tax rates, researchers have been able to more accurately estimate the annual financial tax losses, or profits shifted, due to corporate tax havens specifically. This is not easy, however. As discussed above, havens are sensitive to discussions on effective corporate tax rates and obfuscate data that does not show the headline tax rate mirroring the effective tax rate. Two academic groups have estimated the effective tax rates of corporate tax havens using very different approaches. They are summarized in the following table for the top 8 corporate tax havens: BVI and the Caymans counted as one, as listed in Zuckman's analysis, from Appendix, Table 2. Zuckman used this analysis to estimate that the annual financial impact of corporate tax havens was $250 billion in 2015. This is beyond the upper limit of the OECD's 2017 range of $100 to $200 billion per annum for base erosion and profit-shifting activities. These are the most credible and widely quoted sources of the financial impact of corporate tax havens. The World Bank, in its 2019 World Development Report on the Future of Work, suggests that tax avoidance by large corporations limits the ability of governments to make vital human capital investments. Conduits and Sinks. Modern corporate tax havens like Ireland, the United Kingdom and the Netherlands have become more popular for U.S. corporate tax inversions than leading traditional tax havens, even Bermuda. However, corporate tax havens still retain close connections with traditional tax havens, as there are instances where a corporation cannot retain the untaxed funds in the corporate tax haven, and will instead use the corporate tax haven like a conduit, to route the funds to more explicitly zero tax, and more secretive traditional tax havens. Google does this with the Netherlands to route EU funds untaxed to Bermuda, i.e. Dutch sandwich, to avoid EU withholding taxes, and Russian banks do this with Ireland to avoid international sanctions and access capital markets, i.e. Irish Section 110 SPVs. A study published in Nature in 2017, see Conduit and Sinks FCs, highlighted an emerging gap between corporation tax haven specialists, called Conduit FCs, and more traditional tax havens, called Sinks FCs. It also highlighted that each Conduit FC was highly connected to specific Sinks FCs. For example, Conduit FC Switzerland was highly tied to Sinks FC Jersey. Conduit FC Ireland was tied to Sinks FC Luxembourg, while Conduit FC Singapore was connected to Sinks FCs Taiwan and Hong Kong. The study clarified that Luxembourg and Hong Kong were more like traditional tax havens. The separation of tax havens into Conduit FCs and Sinks FCs enables the corporate tax haven specialist to promote respectability and maintain OECD compliance, critical to extracting untaxed profits from higher taxed jurisdictions via cross-border intergroup IP charging, while enabling the corporate to still access the benefits of a full tax haven, via double Irish, Dutch sandwich type BEPS tools, as needed. We increasingly find offshore magic circle law firms, such as Maples & Calder, and Appleby, setting up offices in major Conduit FCs, such as Ireland. Employment tax. Several modern corporate tax havens, such as Singapore and the United Kingdom, ask that in return for corporates using their IP-based BEPS tools, they must perform work on the IP in the jurisdiction of the haven. The corporation thus pays an effective employment tax of circa 2 to 3% by having to hire staff in the corporate tax haven. This gives the haven more respectability, i.e. not a brass plate location, and gives the corporate additional substance against challenges by taxing authorities. The OECD's Article 5 of the MLI supports havens with employment taxes at the expense of traditional tax havens. Irish IP-based BEPS tools, for example the Capital Allowances for Intangible Assets BEPS scheme, have the need to perform a relevant trade and relevant activities on Irish-based IP, encoded in their legislation, which requires specified employment levels and salary levels, discussed here, which roughly equates to an employment tax of circa 2 to 3% of profits, based on Apple and Google in Ireland. For example, Apple employs 6,000 people in Ireland, mostly in the Apple Hollyhill Cork plant. The Cork plant is Apple's only self-operated manufacturing plant in the world, i.e. Apple almost always contracts to third-party manufacturers. It is considered a low-technology facility, building iMacs to order by hand, and in this regard is more akin to a global logistics hub for Apple, albeit located on the island of Ireland. No research is carried out in the facility. Unusually for a plant, over 700 of the 6,000 employees work from home, the largest remote percentage of any Irish technology company. When the EU Commission completed their state aid investigation into Apple, they found Apple Ireland's ETR for 2004 to 2014 was 0.005% on over €100 billion of globally sourced and untaxed profits. The employment tax is, therefore, a modest price to pay for achieving very low taxes on global profits, and it can be mitigated to the extent that the job functions are real and would be needed regardless. Employment taxes are considered a distinction between modern corporate tax havens and near corporate tax havens, like Luxembourg and Hong Kong, who are classed as Cinco FCs. The Netherlands has been introducing new employment tax type regulations to ensure it is seen as a modern corporate tax haven, more like Ireland, Singapore, and the UK, than a traditional tax haven, for example Hong Kong. UK transformation. The United Kingdom was traditionally a donor to corporate tax havens, for example the last one being Shire plc's Tax Inversion to Ireland in 2008. However, the speed at which the UK changed to becoming one of the leading modern corporate tax havens, at least up until pre-Brexit, makes it an interesting case. It still does not appear on all section corporate tax haven lists. The UK changed its tax regime in 2009 to 2013. It lowered its corporate tax rate to 19%, brought in new IP-based BEPS tools, and moved to a territorial tax system. The UK became a recipient of US corporate tax inversions, and ranked as one of Europe's leading havens. A major study now ranks the UK as the second largest global conduit OFC, a corporate haven proxy. The UK was particularly fortunate as 18 of the 24 jurisdictions that are identified as Cinco FCs, the traditional tax havens, are current or past dependencies of the UK, and embedded into UK tax and legal statute books. New IP legislation was encoded into the UK statute books and the concept of IP significantly broadened in UK law. The UK's Patent Office was overhauled and renamed the Intellectual Property Office. A new UK Minister for Intellectual Property was announced with the 2014 Intellectual Property Act. The UK is now second in the 2018 Global IP Index. The UK's successful transformation from donor to corporate tax havens, to a major global corporate tax haven in its own right, was quoted as a blueprint for type of changes that the US needed to make in the Tax Cuts and Jobs Act of 2017 tax reforms, for example territorial system, lower headline rate, beneficial IP rate. Distorted GDP/GNP. Some leading modern corporate tax havens are synonymous with offshore financial centers, or OFCs, as the scale of the multinational flows rivals their own domestic economies, the IMF's sign of an OFC. The American Chamber of Commerce Ireland estimated that the value of US investment in Ireland was €334 billion, exceeding Irish GDP, €291 billion in 2016. An extreme example was Apple's onshoring of circa $300 billion in intellectual property to Ireland, creating the leprechaun economics affair. However, Luxembourg's GNI is only 70% of GDP. The distortion of Ireland's economic data from corporates using Irish IP-based BEPS tools, especially the capital allowances for intangible assets tool, is so great that it distorts EU28 aggregate data. This distortion means that all corporate tax havens, and particularly smaller ones like Ireland, Singapore, Luxembourg, and Hong Kong, rank at the top in global GDP per capita league tables. In fact, not being a country with oil and gas resources and still ranking in the top 10 of world GDP per capita league tables, is considered a strong proxy sign of a corporate, or traditional, tax haven. GDP per capita tables with identification of haven types are here. Section GDP per capita tax haven proxy. Ireland's distorted economic statistics, post-leprechaun economics and the introduction of modified GNI, is captured on page 34 of the OECD 2018 Ireland survey. This distortion leads to exaggerated credit cycles. The artificial/distorted headline GDP growth increases optimism and borrowing in the haven, which is financed by global capital markets, who are misled by the artificial/distorted headline GDP figures and misprice the capital provided. The resulting bubble in assets/property prices from the build-up in credit can unwind quickly if global capital markets withdraw the supply of capital. Extreme credit cycles have been seen in several of the corporate tax havens, i.e. Ireland in 2009 to 2012 is an example. Traditional tax havens like Jersey have also experienced this. IP-based BEPS tools. Raw materials of tax avoidance. Whereas traditional corporate tax havens facilitated avoiding domestic taxes, e.g. U.S. corporate tax inversion, modern corporate tax havens provide base erosion and profit shifting, or BEPS, tools, which facilitate avoiding taxes in all global jurisdictions in which the corporation operates. This is as long as the corporate tax haven has tax treaties with the jurisdictions that accept royalty payment schemes, i.e. how the IP is charged out, as a deduction against tax. A crude indicator of a corporate tax haven is the amount of full bilateral tax treaties that it has signed. The UK is the leader with over 122, followed by the Netherlands with over 100. BEPS tools abuse intellectual property, or IP, gap accounting techniques, to create artificial internal intangible assets, which facilitate BEPS actions, via. IP is described as the raw material of tax planning. Modern corporate tax havens have IP-based BEPS tools, and are in all their bilateral tax treaties. IP is a powerful tax management and BEPS tool, with almost no other equal, for 4 reasons. When corporate tax havens quote effective rates of tax, they exclude large amounts of income not considered taxable due to the IP-based tools. Thus, in a self-fulfilling manner, their effective tax rates equal their headline tax rates. As discussed earlier, section denials of status, Ireland claims an effective tax rate of circa 12.5%, while the IP-based BEPS tools used by Ireland's largest companies, mostly US multinationals, are marketed with effective tax rates of less than 0 to 3%. These 0 to 3% rates have been verified in the EU Commission's investigation of Apple, see above, and other sources. Encoding IP-based BEPS tools. The creation of IP-based BEPS tools requires advanced legal and tax structuring capabilities, as well as a regulatory regime willing to carefully encode the complex legislation into the jurisdiction's statute books. Note that BEPS tools bring increased risks of tax abuse by the domestic tax base in corporate tax havens' own jurisdiction. See section Irish section 110 SPV for an example. Modern corporate tax havens, therefore, tend to have large global legal and accounting professional service firms in situ. Many classical tax havens lack this, who work with the government to build the legislation. In this regard, havens are accused of being captured states by their professional services firms. The close relationship between Ireland's international financial services centre professional service firms and the state in Ireland, is often described as the Green Jersey Agenda. The speed at which Ireland was able to replace its double Irish IP-based BEPS tool, is a noted example. It is considered that this type of legal and tax work is beyond the normal trust structuring of offshore magic circle type firms. This is substantive and complex legislation that needs to integrate with tax treaties that involve G20 jurisdictions, as well as advanced accounting concepts that will meet US GAAP, SEC and IRS regulations. US multinationals are leading users of IP-based BEPS tools. It is also why most modern corporate tax havens started as financial centers, where a critical mass of advanced professional services firms develop around complex financial structuring. Almost half of the main 10 corporate tax havens are in the 2017 Top 10 Global Financial Centers Index, see section Corporate Tax Haven Lists. The EU Commission has been trying to break the close relationship in the main EU corporate tax havens, i.e. Ireland, the Netherlands, Luxembourg, Malta and Cyprus, the main Conduit and Sinks OFCs in the EU 28, post-Brexit, between law and accounting advisory firms, and their regulatory authorities, including taxing and statistical authorities, from a number of approaches. The knowledge economy. Modern corporate havens present IP-based BEPS tools as innovation economy, new economy or knowledge economy business activities. For example, some use the term knowledge box or patent box for a class of IP-based BEPS tools, such as in Ireland and in the UK. However, their development as a GAAP accounting entry, with few exceptions, is for the purposes of tax management. When Apple onshored $300 billion of IP to Ireland in 2015, Leprechaun Economics, the Irish Central Statistics Office suppressed its regular data release to protect the identity of Apple, unverifiable for 3 years, until 2018, but then described the artificial 26.3% rise in Irish GDP as meeting the challenges of a modern globalized economy. The CSO was described as putting on the green jersey. Leprechaun Economics, an example of how Ireland was able to meet with the OECD's transparency requirements, and score well in the Financial Secrecy Index, and still hide the largest BEPS action in history. As noted earlier, Section UK Transformation, the UK has a Minister for Intellectual Property and an Intellectual Property Office, as does Singapore, Intellectual Property Office of Singapore. The top 10 list of the 2018 Global Intellectual Property Center IP Index, the leaders in IP management, features the 5 largest modern corporate tax havens: United Kingdom, number 2, Ireland, number 6, the Netherlands, number 7, Singapore, number 9, and Switzerland, number 10. This is despite the fact that patent protection has traditionally been synonymous with the largest, and longest established, legal jurisdictions, i.e. mainly older G7-type countries. German royalty barrier failure. In June 2017, the German Federal Council approved a new law called an IP royalty barrier, Lizenzschrank, that restricts the ability of corporates to deduct intergroup cross-border IP charges against German taxation, and also encourage corporates to allocate more employees to Germany to maximize German tax relief. The law also enforces a minimum effective 25% tax rate on IP. While there was initial concern amongst global corporate tax advisors, who encode the IP legislation, that a royalty barrier was the beginning of the end for IP-based BEPS tools, the final law was instead a boost for modern corporate tax havens, whose OECD-compliant, and more carefully encoded and embedded IP tax regimes, are effectively exempted. More traditional corporate tax havens, which do not always have the level of sophistication and skill in encoding IP BEPS tools into their tax regimes, will fall further behind. The German royalty barrier law exempts IP charged from locations which have. One of Ireland's main tax law firms, Matheson, whose clients include some of the largest US multinationals in Ireland, issued a note to its clients confirming that the new German royalty barrier will have little effect on their Irish IP-based BEPS structures, despite them being the primary target of the law. In fact, Matheson notes that new law will further highlight Ireland's robust solution. The failure of the German royalty barrier approach is a familiar route for systems that attempt to curb corporate tax havens via an OECD compliance type approach. See section failure of OECD BEPS project, which is what modern corporate tax havens are distinctive in maintaining. It contrasts with the U.S. Tax Cuts and Jobs Act of 2017, see section failure of OECD BEPS project, which ignores whether a jurisdiction is OECD compliant or not, and instead focuses solely on effective taxes paid, as its metric. Had the German royalty barrier taken the US approach, it would have been more onerous for havens. Reasons for why the barrier was designed to fail is discussed in Complex Agendas. IP and post-tax margins. The sectors most associated with IP, for example, technology and life sciences, are generally the sum of the most profitable corporate sectors in the world. By using IP-based BEPS tools, these profitable sectors have become even more profitable on an after-tax basis by artificially suppressing profitability in higher tax jurisdictions, and profit shifting to low-tax locations. For example, Google Germany should be even more profitable than the already very profitable Google US. This is because the marginal additional costs for firms like Google US of expanding into Germany are very low. The core technology platform has been built. In practice, however, Google Germany is actually unprofitable, for tax purposes, as it pays intergroup IP charges back to Google Ireland, who reroutes them to Google Bermuda, who is extremely profitable, more so than Google US. These intergroup IP charges, i.e. the IP-based BEPS tools, are artificial internal constructs. Commentators have linked the cyclical peak in US corporate profit margins with the enhanced after-tax profitability of the biggest US technology firms. For example, the definitions of IP in corporate tax havens such as Ireland has been broadened to include theoretical assets, such as types of general rights, general know-how, general goodwill, and the right to use software. Ireland's IP regime includes types of internally developed intangible assets and intangible assets purchased from connected parties. The real control in Ireland is that the IP assets must be acceptable under GAAP. Older 2004 Irish GAAP is accepted, and thus auditable by an Irish international financial services centre accounting firm. A broadening range of multinationals are abusing IP accounting to increase after-tax margins, via intergroup charge-outs of artificial IP assets for BEPS purposes, including. It has been noted that IP-based BEPS tools such as the patent box can be structured to create negative rates of taxation for IP-heavy corporates. IP-based tax inversions. Apple versus Pfizer-Allergan. Modern corporate tax havens further leverage their IP-based BEPS toolbox to enable international corporates to execute quasi-tax inversions, which could otherwise be blocked by domestic anti-inversion rules. The largest example was Apple's Q1 January 2015 restructuring of its Irish business, Apple Sales International, in a quasi-tax inversion, which led to the Paul Krugman-labelled Leprechaun Economics affair in Ireland in July 2016, see article. In early 2016, the Obama administration blocked the proposed $160 billion Pfizer-Allergan Irish corporate tax inversion, the largest proposed corporate tax inversion in history. A decision which the Trump administration also upheld. However, both administrations were silent when the Irish state announced in July 2016 that 2015 GDP has risen 26.3% in one quarter due to the onshoring of corporate IP, and it was rumored to be Apple. It might have been due to the fact that the Central Statistics Office, Ireland, openly delayed and limited its normal data release to protect the confidentiality of the source of the growth. It was only in early 2018, almost 3 years after Apple's Q1 2015 $300 billion quasi-tax inversion to Ireland, the largest tax inversion in history, that enough Central Statistics Office, Ireland, data was released to prove it definitively was Apple. Financial commentators estimate Apple onshored circa $300 billion in IP to Ireland, effectively representing the balance sheet of Apple's non-U.S. business. Thus, Apple completed a quasi-inversion of its non-US business, to itself, in Ireland, which was almost twice the scale of Pfizer-Allergan's $160 billion blocked inversion. Apple's IP-based BEPS inversion. Apple used Ireland's new BEPS tool, and double Irish replacement, the Capital Allowances for Intangible Assets scheme. This BEPS tool enables corporates to write off the arm's length, to be OECD compliant, intergroup acquisition of offshored IP, against all Irish corporate taxes. The arm's length criteria are achieved by getting a major accounting firm in Ireland's International Financial Services Centre to conduct a valuation, and Irish GAAP audit, of the IP. The range of IP acceptable by the Irish Revenue Commissioners is very broad. This BEPS tool can be continually replenished by acquiring new offshore IP with each new product cycle. In addition, Ireland's 2015 Finance Act removed the 80% cap on this tool, which forced a minimum 2.5% effective tax rate, thus giving Apple a 0% effective tax rate on the onshored IP. Ireland then restored the 80% cap in 2016, and a return to a minimum 2.5% effective tax rate, but only for new schemes. Thus, Apple was able to achieve what Pfizer-Allergan could not, by making use of Ireland's advanced IP-based BEPS tools. Apple avoided any US regulatory scrutiny/blocking of its actions, as well as any wider US public outcry, as Pfizer-Allergan incurred. Apple structured an Irish corporate effective tax rate of close to zero on its non-US business, at twice the scale of the Pfizer-Allergan inversion. Debt-based BEPS tools. Dutch double dip. While the focus of corporate tax havens continues to be on developing new IP-based BEPS tools, such as OECD-compliant knowledge/patent boxes, Ireland has developed new BEPS tools leveraging traditional securitization SPVs, called Section 110 SPVs. Use of intercompany loans and loan interest was one of the original BEPS tools and was used in many of the early U.S. corporate tax inversions, was known as earnings stripping. The Netherlands has been a leader in this area, using specifically worded legislation to enable IP-light companies further amplify earnings stripping. This is used by mining and resource extraction companies, who have little or no IP, but who use high levels of leverage and asset financing. Dutch tax law enables IP-light companies to overcharge their subsidiaries for asset financing, i.e. reroute all untaxed profits back to the Netherlands, which is treated as tax-free in the Netherlands. The technique of getting full tax relief for an artificially high interest rate in a foreign subsidiary, while getting additional tax relief on this income back home in the Netherlands, became known by the term, double dipping. As with the Dutch sandwich, Dutch Minister Joop Wajden is credited as its creator. Irish Section 110 SPV. The Irish Section 110 SPV uses complex securitization loan structuring, including auftoning, which adds confidentiality, to enable the profit shifting. This tool is so powerful, it inadvertently enabled US distressed debt funds avoid billions in Irish taxes on circa €80 billion of Irish investments they made in 2012 to 2016, see Section 110 abuse. This was despite the fact that the seller of the circa €80 billion was mostly the Irish state's own National Asset Management Agency. The global securitization market is circa $10 trillion in size, and involves an array of complex financial loan instruments, structured on assets all over the world, using established securitization vehicles that are accepted globally, and whitelisted by the OECD. This is also helpful for concealing corporate BEPS activities, as demonstrated by sanctioned Russian banks using Irish Section 110 SPVs. This area is therefore an important new BEPS tool for EU corporate tax havens, Ireland and Luxembourg, who are also the EU's leading securitization hubs. Particularly so, given the new anti-IP-based BEPS tool taxes of the U.S. Tax Cuts and Jobs Act of 2017, TCJA, i.e. the new GILTI tax regime and BEAT tax regime, and proposed EU Digital Services Tax, DST, regimes. The US TCJA anticipates a return to debt-based BEPS tools, as it limits interest deductibility to 30% of EBITDA, moving to 30% of EBIT post-2021. While securitization SPVs are important new BEPS tools, and acceptable under global tax treaties, they suffer from substance tests, i.e. challenges by tax authorities that the loans are artificial. Irish Section 110 SPV's use of profit participation notes, i.e. artificial internal intergroup loans, is an impediment to corporates using these structures versus established IP-based BEPS tools. Solutions such as the Often Superkief have been created in the Irish tax code to resolve this. However, while debt-based BEPS tools may not feature with US multinational technology companies, they have become attractive to global financial institutions. who do not need to meet the same substance tests on their financial transactions. In February 2018, the Central Bank of Ireland upgraded the little-used Irish LCAF regime to offer the same tax benefits as Section 110 SPVs, but without the need for profit participation notes and without the need to file public accounts with the Irish CRO, which had exposed the scale of Irish domestic taxes. Section 110 SPVs had been used to avoid abuses. Ranking corporate tax havens. Proxy tests. The study and identification of modern corporate tax havens are still developing. Traditional qualitative-driven IMF-OST financial secrecy index-type tax haven screens, which focus on assessing legal and tax structures, are less effective given the high levels of transparency and OECD compliance in modern corporate tax havens, i.e. most of their BEPS tools are OECD whitelisted. Quantitative measures. More scientific are the quantitative-driven studies, focused on empirical outcomes, such as the work by the University of Amsterdam's Cornetin Conduit and Sinks FCs, and by University of Berkeley's Gabriel Zuckman. They highlight the following modern corporate tax havens, also called Conduit FCs, and also highlight their partnerships with key traditional tax havens, called Sinks FCs. The only jurisdiction from the above list of major global corporate tax havens that makes an occasional appearance in OECD IMF tax haven lists is Switzerland. These jurisdictions are the leaders in IP-based BEPS tools and use of intergroup IP charging and have the most sophisticated IP legislation. They have the largest tax treaty networks and all follow the section employment tax approach. The analysis highlights the difference between suspected onshore corporates need the broadest tax treaties for their BEPS tools, and therefore prefer to base themselves in Conduit FCs, Ireland and Singapore, which can then route the corporates' funds to the Sinks FCs, Luxembourg and Hong Kong. Of the major Sinks FCs, they span a range between traditional tax havens, with very limited tax treaty networks, and near-corporate tax havens. The above 5 corporate tax haven Conduit FCs, plus the 3 general tax haven Sinks FCs, counting the Caribbean triad as one major Sinks FC, are replicated at the top 8 to 10 corporate tax havens of many independent lists, including the Oxfam list, and the ITEP list. See section Corporate Tax Haven Lists. Ireland as global leader. Gabriel Zuckman's analysis differs from most other works in that it focuses on the total quantum of taxes shielded. He shows that many of Ireland's US multinationals, like Facebook, don't appear on Orbis, the source for quantitative studies, including Cornets, or have a small fraction of their data on Orbis, Google and Apple. Analyzed using a quantum of funds method, not an Orbis corporate connections method, Zuckman shows Ireland as the largest EU28 corporate tax haven, and the major route for Zuckman's estimated annual loss of 20% in EU28 corporate tax revenues. Ireland exceeds the Netherlands in terms of quantum of taxes shielded, which would arguably make Ireland the largest global corporate tax haven. It even matches the combined Caribbean triad of Bermuda, British Virgin Islands, the Cayman Islands. See section Zuckman Corporate Tax Havens. Failure of OECD BEPS project. Reasons for the failure. The rise of modern corporate tax havens, like the United Kingdom, the Netherlands, Ireland, and Singapore, contrasts with the failure of OECD initiatives to combat global corporate tax avoidance and BEPS activities. There are many reasons advocated for the OECD's failure, the most common being, it has been noted in the OECD's defense, that G8 economies like the US were strong supporters of the OECD's IP work, as they saw it as a tool for their domestic corporates, especially IP-heavy technology and life sciences firms, to charge out US-based IP to international markets and thus, under US bilateral tax treaties, remit untaxed profits back to the US. However, when US multinationals perfected these IP-based BEPS tools and worked out how to relocate them to zero tax places such as the Caribbean or Ireland, the US became less supportive, i.e. US 2013 Senate investigation into Apple in Bermuda. However, the US lost further control when corporate havens such as Ireland developed closed-loop IP-based BEPS systems, like the Capital Allowances for Intangibles tool, which bypass US anti-corporate tax inversion controls, to enable any US firm, even IP-light firms, create a synthetic corporate tax inversion, and achieve 0 to 3% Irish effective tax rates, without ever leaving the U.S. Apple's successful $300 Q1 2015 billion IP-based Irish tax inversion, which came to be known as leprechaun economics, compares with the blocked $160 billion Pfizer-Allergan Irish tax inversion. The closed-loop element refers to the fact that the creation of the artificial internal intangible asset, which is critical to the BEPS tool, can be done within the confines of the Irish office of a global accounting firm, and an Irish law firm, as well as the Irish Revenue Commissioners. No outside consent is needed to execute the BEPS tool, and use via Ireland's global tax treaties, save for two situations. Departure of US and EU. The 2017-18 US and EU Commission taxation initiatives deliberately depart from the OECD BEPS project, and have their own explicit anti-IP BEPS tax regimes, as opposed to waiting for the OECD. The US GILTI and BEAT tax regimes are targeted at US multinationals in Ireland, while the EU's digital services tax is also directed at perceived abuses by Ireland of the EU's transfer pricing systems, particularly in regard to IP-based royalty payment charges. For example, the new US GILTI regime forces US multinationals in Ireland to pay an effective corporate tax rate of over 12%, even with a full Irish IP BEPS tool, i.e. single malt, whose effective Irish tax rate is circa 0%. If they pay full Irish headline 12.5% corporate tax rate, the effective corporate tax rate rises to over 14%. This is compared to a new US FDI tax regime of 13.125% for US-based IP, which reduces to circa 12% after the higher US tax relief. US multinationals like Pfizer announced in Q1 2018, a post-TCJA global tax rate for 2019